Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
रामू दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का home loan? I agree with you.
SBI is the banker to every Indian.
In the surprise announcement, RBI Governor Shaktikanta Das on Wednesday said that the Monetary Policy Committee has unanimously voted to increase the repo rate by 40 basis points to 4.4% with immediate effect. The repo rate has been increased for the first time since August 2018. What will be its impact on the economy? Also, what will be the impact on home buyers, borrowers and FD investors? Let's find out.
In an unscheduled press briefing yesterday, RBI Governor Shaktikanta Das said that the Monetary Policy Committee's off-cycle meet had unanimously voted to hike rates. The rationale behind this decision was the upside risks posed by global factors to India's inflation trajectory. The repo rate now stands at 4.40% with immediate effect. Consequently, the standing deposit facility rate stands adjusted to 4.15%. Meanwhile, the marginal standing facility rate and the bank rate stand adjusted to 4.65%. However, the Monetary Policy Committee has decided to remain accommodative while focusing on the withdrawal of accommodation. This is aimed at ensuring that inflation remains within the target going forward, while supporting growth. Driven by food inflation, the headline inflation number in March had touched 7%. And high-frequency price indicators for April have indicated that food price pressures would persist. At the same time, the direct impact of the increases in domestic pump prices is feeding into core inflation prints and is expected to have intensified in April. Effective from the fortnight beginning 21st May, the RBI has also hiked the cash reserve ratio by 50 basis points to 4.5% of net demand and time liabilities. This is expected to withdraw liquidity to the tune of 87,000 crore rupees from the system. So, how is it going to impact home buyers? Analysts say that this is the beginning of the end of low-interest home loans. According to Anurag Group Chairman Anuj Puri, for home buyers, this hike signals an imminent end to the all-time low-interest regime. Low interest has been one of the major drivers behind home sales across the country since the pandemic began. The rise in interest rates will ultimately impact overall acquisition cost for home buyers and may dampen residential sales to some extent. In fact, the policy decision will impact all loans, from home loans and car loans to personal loans. Let's say you are planning to take a loan. You should act quickly to ensure that the loan is disbursed at the present lower rates. However, this applies to fixed rate loans such as personal loans and auto loans. This won't be of much help for new home loan borrowers because those are mostly floating rate loans. And fixed deposit rates are set to rise. Ideally now, a depositor should consider locking funds in shorter duration FDs in order to enjoy the benefit of higher interest rates in the coming months. We spoke to Madan Sabnavis, Chief Economist at Bank of Baroda, to understand the impact on economic recovery, inflation and cost of credit.
In terms of inflation, it would have a kind of a mixed impact. I see a mixed impact because lots of commodity prices which have gone up are because of supply side pressures, that is exogenous shocks which are being emanating from the global economy. For example, crude oil prices are up. That's a global factor. Edible oil prices are up because of embargo which is there on importing oil from Russia. Or recently we've seen Indonesia has put a ban on export of crude palm oil and RBD. So these are the factors over which actually the Reserve Bank has little control. So will these prices come down? The answer is probably no. But if you're looking at the way in which monetary policy operates, by increasing the rates, you will be able to control excess demand pressures, which will be mainly in the form of fresh investment, which is taking place. Because today, if companies go in for fresh investment, there would be a tendency for higher demand to be generated, which in turn could push up the prices of goods further. So with both consumption as well as investment slowing down, there would be a tendency for growth to also slow down. So we at Bank of Baroda earlier had a forecast of around 7.4 to 7.5%. There could be a downside of around 25 basis points. In terms of inflation, we earlier felt it would be in the region of 5.5 to 6%. But given the kind of way in which things have evolved outside, we could be expecting inflation to be around 6% still with an upward bias. It could go towards 6.5 and 7%, especially in the next couple of months. So overall growth may not be retarded significantly on account of the interest rate hike. At the margin, of course, there would be an impact on investment and property consumption. So therefore, growth will be lower than what we had projected earlier, but it will not be more than, say, 25 basis points on the downside. The cost of credit will definitely go up, and so industry will have to pay a higher interest rate. So this is a cost which has to be borne by industry. How significant is it? We have generally seen on an average basis, the ratio of interest costs to net sales or your turnover is in a region of around 3 to 4%. So while definitely it would get impacted, it would not be broad-based. I think only sectors which are highly leveraged, which depend a lot on borrowing, they're the ones who will probably be affected. But on the whole, profit margins will be affected at a margin, but not very significantly, purely on the basis of the interest rate hike which we are seeing today.
For the financial markets, it is now evident that the central bank has finally embarked on the policy normalization process.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
While the RBI's rate hike signals the end of low interest regime for home buyers, China's new lockdown measures have also put the consumer durables buyers in India at unease. The backlog of cargo and container ships near Shanghai port is likely to affect the consumer durables market, which heavily depends on components from China. As inventories of TV, AC and refrigerator makers in India could reportedly start drying up from mid-May. Our next report analyzes the looming crisis to understand its impact on consumers.
If you're planning to bring home an air conditioner, refrigerator, or a washing machine in a week's time or two, chances are your nearest retailer may not have the full inventory to let you choose from. And it's not a sulking salesman you're dealing with. You're out for shopping at a time when consumer durable companies in India are struggling with diminishing inventories. And that's because consumer durable companies in India, which depends heavily on components from China, have been affected by the pileup of cargo ships near Shanghai port. Employees of the Chinese port are reportedly unable to go to work because of strict COVID-induced lockdown in the region. Demand for summer products like refrigerators and air conditioners has been improving during the past few months, recovering from the pandemic setbacks. But supply-side constraints and soaring inflation drove input costs at lifetime highs, making consumers brace for price hikes. This was followed by COVID-induced curbs in China, all of which are now impacting the production of consumer and electronic products. For Eric Braganza of the Consumer Electronics and Appliances Manufacturers Association, it is difficult to predict the extent of the impact the lockdown in China would have on consumer durable companies right now. Speaking to Business Standard, he said a few models could go out of stock due to delays in components coming from China. Contract manufacturer Dixon Technologies also reports shortage in component supply during the past 3 weeks as shipments delayed are already in the pipeline. However, Super Prestonics, the brand licensee of Kodak, Thomson, Blowpunk and Westinghouse in India, is in a better position. The company has stocked up in October-December and January-March, anticipating some disruption, says Avneet Singh Marwa, Chief Executive of Super Prestonics.
If you were to look at the state of play on the demand side, we are witnessing relatively high demand for consumer durables such as televisions and refrigerators. This is primarily driven by consumers operating in a remote or hybrid work environment, plus the record high temperatures that we are witnessing. So in the run-up to the peak summer season, there was so much to look forward to. If you were to look at on the supply side, many consumer durable brands did stock up on inventories to prevent a repeat of the supply side crunches that they faced through the course of the pandemic. However, as a consequence of the recent pandemic-induced lockdowns in China, and especially freight containers getting stuck at major ports such as Shanghai, the supply of key components used in consumer durables continues to be in short supply. If the situation is not reversed in the course of the next month or so, consumer durable brands are looking at tough times ahead. And what this means for the end consumer is a price rise across the board.
Consumer product companies dealing in refrigerator and air conditioner estimate supplies will be lower than demand from May onwards, owing to the heat wave and pent-up demand. The shortage in supply of consumer electronic components from China will only widen this demand and supply gap in the coming months.
क्या हाल?
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Back to the markets. The out-of-policy hike in repo rate by 40 basis points and a 50 basis point hike in the cash reserve ratio by the Reserve Bank of India took investors by surprise on Wednesday. The decision came unexpectedly and on the opening day of LIC's IPO. With the RBI getting more hawkish than expected, here is what the road ahead looks like for the markets.
Indian equities came crashing down on the bourses yesterday as the Reserve Bank of India announced a surprise rate hike. In an unscheduled address, RBI Governor Shaktikanta Das announced a 40 basis point increase in repo rate to 4.4%. This was the first rate hike since August 2018. Besides, the RBI also raised the CRR or cash reserve ratio by 50 basis points to 4.5% in a bid to suck liquidity out of the system. Today's rate hike, along with April policy's decision on the standing deposit facility, makes the effective rate higher by 80 basis points. Thus, along with the simultaneous CRR increase, the central bank will withdraw liquidity to the tune of 90,000 crore rupees from May 21. The move sent equities into a tailspin as investors had priced a repo rate revision only in the June monetary policy review. The S&P BSE Sensex tumbled 1,307 points to close at 55,669, while the Nifty 50 dropped 392 points to 16,678. The Nifty Bank Index, meanwhile, fell 2.5% to end at 35,264. In the money markets, 10-year government bond yields jumped nearly 4% to 7.3%.
of course, this is a mid-cycle sort of announcement. So therefore, that sort of surprised the market a bit. Otherwise, the market was on its own track. So that is one. Second, probably even if there was a hike, people would have probably expected 25. So it was 40. So there was a bit higher. And of course, coupled with CRR. But I think they keep saying that they will continue to have their commodities down. So therefore, on the whole, I think it is just that there was some element of surprise in this. That is where the market has tanked. But I think market will probably, come back to, will accept this because, if not today, it would have probably happened probably a few weeks later. But, there was something certainly on the works and the market really expected this to happen anyway. So, but just that it was sort of preponed and it was sort of done out of turn. So that is why the market was probably a bit perplexed. But I think things will come back to normal quite pretty soon. I think this can be easily absorbed by the economy.
Analysts feel rate-sensitive sectors like banking, NBFCs, automobile, and real estate may remain choppy in the near term as a sudden increase in interest rates signals an imminent end to the all-time low interest rate regime, which has been one of the major drivers for credit revival across segments. Going ahead, it could be a bumpy road for the markets as they have broken their immediate support levels on the tech charts.
In the recent trading sessions, we have seen benchmark indices Sensex and Nifty trading in a broad range of 58 to 56,000 for Sensex, and for Nifty it was 17,500 to 16,800 levels. The announcement of raising hike by RBI on Wednesday spooked a negative downside wherein both the indices breached their lower levels of the broad range. We close on a negative note. However, subsequent days opening becomes a crucial indication for the trend ahead. For the Sensex, if we open under 55,000, then we could drift towards 54 and can see even lower levels. Similarly, for Nifty, if we opens under 16,500, then we can drift to 16,300 to 16,100 levels. However, if you have a flat opening or opening with minor losses, and if both the indices manage to trade within those opening range for say 30 to 40 minutes, then we could definitely see a rebound within this broad range.
Thursday's trading action will also be clouded by investors' assessment of the RBI policy action and the weekly FNO expiry. That apart, the US Federal Reserve's interest rate decision will also guide the indices today. Moreover, LIC's 21,000 crore rupee IPO may also move participation away from secondary markets. At the end of day one, the mega public offer was subscribed over 60%, driven by policyholders and employees. Their portions were subscribed nearly 2 times and 100% respectively. Retail investors' quota, meanwhile, was subscribed a little over 50%.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Apart from a bull and bear trend, markets also witness phases of consolidation. In today's Decoded, we delve into what is a consolidation phase, how to identify it, and trade during such a phase. Let's find out.
The markets go through various phases such as bull, bear, and consolidation. A consolidation phase is one in which a stock or an index moves within a specific range between the support and resistance levels. Inadvertently, price reverses from the specific lower levels, that is supports, and face selling pressure at higher levels, that is resistances. This scenario, by and large, defines a consolidation phase. Let's delve a bit deeper into this market phenomena and learn how to identify and trade during such phases. When prices move in a range between support and resistance levels, and indicators like relative strength index, moving averages, convergence, divergence see sideways movement. Doji, hammer, spinning top are some of the prominent candlestick patterns visible during consolidation. The highlighted area on the Hindustan Unilever line chart is a consolidation phase. The stock moved in a narrow band over a period of time as marked by the horizontal lines. The rectangular boxes highlight on the RSI, MACD indicate lack of strength and momentum at the counter. The circled areas highlight the breakout on the charts alongside rise in volume. As shown in the chart, a major trade signal called a breakout happens only when the price moves out of either the support or resistance levels. Similarly, a stock's major outlook can be studied on its monthly chart. Longer the consolidation, bigger the price action can be expected thereafter. Having said that, here's how one can trade in a stock underlying index when in a consolidation phase. The major trading signal called a breakout happens only when the price moves out of the consolidation zone by breaching either the support or resistance level. However, traders should take note that unless there is a breakout with definite consecutive closes, one should not be in a hurry to confirm the trend and take positions. For at times, a dull scenario on the charts can also result in a build-up of short positions.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.